Welcome to our video on understanding IRS interest rates. As taxpayers, it's essential to be aware of these rates as they influence our tax payments and refunds. In this video, we will cover an overview of IRS interest rates, discuss key rates, explain the calculation method, explore important considerations, and wrap up with some final tips. Make sure to stick around until the end for an important disclaimer. The IRS sets interest rates for underpayments and overpayments of taxes. These rates are revised quarterly and can affect how much interest you earn on refunds or owe on outstanding tax balances. For the second quarter of 2025, the IRS announced that both the overpayment and underpayment rates stand at 7%. This consistency offers stability for taxpayers planning their finances. The IRS calculates these interest rates by using the federal short-term rate and adding 3 percentage points. This process utilizes the federal short-term rate from the preceding October to determine the rates for the upcoming quarter. Here's a quick quiz to test your understanding. How does the IRS determine interest rates for underpayments and overpayments? Is it A, using the previous year's inflation rate, B, federal short-term rate plus 3%, C, arbitrarily, or D, based on taxpayer income? You can pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. The IRS determines interest rates for underpayments and overpayments by taking the federal short-term rate and adding 3 percentage points. This calculation uses the federal short-term rate from October of the previous year. There are several important considerations for taxpayers to keep in mind. Firstly, consider the strategy of overpayment to earn interest, but make sure to weigh the potential returns against the opportunity cost. Secondly, underpayment penalties can vary based on the amount and duration of underpayment, so follow IRS guidelines for accurate calculations. Lastly, even though the Federal Reserve influences overall interest rates, the IRS sets its rates independently. In conclusion, staying informed about IRS interest rates is key for effective tax planning. Knowing how these rates are determined and what impacts they have helps you manage your obligations better and maximize your financial outcomes. Always consult a financial advisor for strategic decisions. Please note, this video is intended for educational purposes only and does not constitute financial or legal advice. For tailored assistance, consult a qualified professional. Understanding these distinctions will avoid potential misconceptions. Thank you for watching this video. If you found it helpful, please give it a thumbs up, subscribe to our channel, and share your thoughts or questions in the comments below. We value your feedback.